Observers of the stock market are raising alarms. I believe we are in what may be the largest bubble of my professional life. Risky assets like real estate, tech stocks, and even cryptocurrencies have become popular among investors. Particularly for cryptocurrencies, which are essentially speculative assets, asset valuations are a little high. They certainly seem hazardous to me. They have no supporting evidence. It is widely held that the Federal Reserve, the nation's premier bank, was the source of the market's troubles. Analysts estimate that throughout the next few years, the Fed will reduce its bond holdings by $2 to $3 trillion. Markets would stabilize as a result, but there is a chance that a recession might start if the Fed removes its emergency stimulus program too soon. Raising interest rates and tightening policy just enough to control inflation without sending the economy into a recession is the key task. Better spoken than done. Not all of history is on their side. Therefore, how did the Fed come to own assets valued at around $9 trillion? And can it sell them without negatively impacting the economy? The Federal Reserve, the nation's central bank, is used by the U.S. government to control the economy. A significant crisis preceded the creation of the Federal Reserve itself. In 1987, there was a financial crisis. We didn't have a central bank, but after a thorough investigation, it was determined that having a central bank that could print more money in times of need would help prevent similar crises in the future. The Federal Reserve has shown time and time again that it is in a strong position to act as the first to act in the event of a shock. The federal funds interest rate is the Fed's most significant weapon. Currently, the Fed funds rate ranges from 0% to 0.25%. They can only sink to that level. The near-zero interest rates were extremely exceptional. The Fed essentially determines the interest rate at which banks lend money to one another overnight. All other rates that consumers pay, such as those for auto loans, home equity lines of credit, and mortgages, originate from that short-term rate. But in the end, the market and banks determine all rates based on the Federal Reserve's short-term overnight rate. In response to the unique financial circumstances in the United States, central banks worldwide have maintained low interest rates to encourage additional growth, but bankers have refused to use negative interest rates. Rather, they have utilized instruments such as the bond portfolio to provide economic stimulus. They use a balance sheet to monitor their expenditures. Every bank possesses a balance sheet. Both assets and liabilities belong to them. The money in circulation known as Federal Reserve notes represents the liabilities. On the balance sheet's asset side, it is the main liability. Next, the Federal Reserve has made other purchases, including certain mortgages and government assets. All of it stems from the requirement to employ assets to back up those liabilities and currencies in circulation. When the financial system begins to collapse, the Fed has the authority to print more money. Experts refer to it as the lender of last resort because of this. In many ways, the Federal Reserve's original role was that of lender of last resort. Initially, we opposed the establishment of a central bank due to concerns about the concentration of power in that manner. Nevertheless, since this role was necessary, it made sense to establish it in a manner that would facilitate supervision and responsibility. During the majority of its 100-year life, the balance sheet was not heavily utilized by the Federal Reserve. At 11 o'clock, at that point, the balance sheet was the largest it had ever been, with an estimated value of $750 to $800 billion. Dr. Ferguson departed the central bank just before the 2008 housing crisis. Anxious investors began to exit the overall market during that episode as they watched the real estate industry. Ben Bernanke, the chair of the Federal Reserve, approved a massive bond buyback program that quickly increased the balance sheet and prevented the financial system from collapsing completely. The pundits referred to it as quantitative easing, emphasizing the quantitative in the phrase. The goal of quantitative easing was to encourage the development of more credit. The main premise behind this was that they might encourage even more accommodating credit conditions and attempt to increase economic activity by accumulating safe assets, treasuries, and agency mortgage-backed securities. Bonds are purchased by investors hoping to earn a small but guaranteed return. Among all assets, U.S. Treasury bonds are arguably the safest. The majority of mortgages that the Federal Reserve is purchasing are referred to be conforming mortgages, which are seen as a risk-free asset, incredibly liquid and deep market. Utilizing a portfolio that balances these bonds against stocks is advised by many conventional investors. However, these secure bonds are being taken by the Federal Reserve when it enters the market. Generating income from them falls for all. From the standpoint of the investor, this will increase the likelihood that they will ideally be allocating their resources in ways that foster private innovation. Having a balance sheet that is so big, nearly $9 trillion, has led to the current situation where a lot of money is going into riskier assets. And you began to see some absurd companies that aren't actually that successful, or that can generate a lot of money through an initial public offering, IPO. in 2020 or even 2021. In the end, those companies fail. Numerous investors will find themselves somewhat unsatisfied. The Federal Reserve's purchasing patterns have become increasingly important to the markets, but by placing the Fed at the center of efforts to provide capital to businesses in the spring and summer of 2020, we did contribute to the creation of an environment where we did much more to support some extremely vulnerable financial intermediaries. Therefore, if you were a big business, it didn't matter if you were a highly or poorly creditworthy big business. Over the previous few years, you have demonstrated an incredible capacity to raise capital by issuing additional loans. Securitized mortgage loans are among the atypical assets that the central bank has acquired. This has generated debate among certain people. How many of you would be willing to foot the tab for your neighbor who can't pay their bills and has an additional bathroom? Put up their hand. President Obama, how about we all do this? Do you hear me? The markets were forewarned by the Federal Reserve that it was time to wind down the balance sheet. That created a panic among day traders. We are going to remove quantitative easing within the next year or sooner. We're going to stop purchasing bonds. The addition of fresh reserves that generate the required amount of money will cease. That does not bode well for gold. I believe that the extremely low interest rate environment when investing in riskier assets was necessary to pursue returns has contributed significantly to the fervor surrounding them. Large enterprises benefited from the significant cash infusions at the expense of smaller companies. As we saw with the Main Street Loan Program, which was meant to assist mid-sized enterprises, the Fed just lacked the resources to effectively assist small businesses. Furthermore, the Fed lacked the necessary resources to effectively assist them. The biggest businesses in our nation, on the other hand, have far greater access to capital through channels like debt issuance on open markets. And these bond-backed ETFs and open-end funds have snapped this up like crazy. Furthermore, we do not want the intricate web of interconnected systems that makes up the financial system to come to a complete stop due to a shortage of liquidity, which would force a recession. Following nearly every crisis, following a poll, commission, hearing, etc., Congress determines how to reallocate the powers to address these crises. Our epidemic asset purchases will come to an end as a result, eliminating another unnecessary source of economic stimulus for the economy. These actions should help to reduce inflationary pressures in the upcoming months, in my opinion. Undoubtedly, a few members of the committee are eager to start cutting this balance sheet. Compared to earlier attempts after the housing catastrophe, the Fed intends to liquidate its asset holdings more quickly. All of us may discover that previously extremely low levels of interest rates, loan costs, and money prices are gradually beginning to rise. That I've previously seen in part. Compared to earlier times, mortgage rates have somewhat increased. Additionally, corporate borrowing rates are a little higher. In this cycle, the Fed will reduce the $3 trillion worth of bonds in its portfolio. A recession could be triggered by market volatility that comes after the Fed tightens the economy. Will the Fed's balance sheet revert to its pre-crisis levels from 2006 and early 2007? They have far greater skepticism. Reserves now play a very different role on bank balance sheets. Saying that the balance sheet shouldn't be used the way it is unfair. This gadget is brand new. One thing that's novel about it is how frequently it's being utilized. Secondly, it's being deployed on a scale never thought possible. Although it is highly visible, you might not see it, much like many things that are in plain sight. Did you like it? Tell us what you think of the video in the comments section below, and don't forget to subscribe to our YouTube channel for more interesting videos.